Right, next installment in the debits and credits saga actually includes the terms debits and credits and what they mean. Again, I started you out with the idea of left and right because that's the easiest way to introduce what you're doing here is just say, well, the real rule that you're trying to conquer is just left equals right. But of course, again, like, okay, how did we transform from left and right to debits and credits? What was the transition of those terms? Well, simply put, when you're dealing with a profession, professions are inclined to come up with specialized jargon so that other people, lay people, don't understand what they're talking about. So accountancy is no different. So somewhere along the line, somebody said, well, let's just relabel left and right debit and credit. So that's where this debits equals credits rule came from. But again, essentially, it's just left equals right. That's what it always means in its most fundamental sense. Now, I know some people might have a bit of a problem with one of these terms. I already know which one it is. It's the one right here, debits. Some people have a preconceived notion or a feeling, inclination of negativity towards that one because you've been conditioned to think of those as having something that could have a negative connotation. And again, that's why I threw this little don't think of them in terms of good and evil, because there's nothing there. It's just left and right. It's just a positional designation that you're dealing with here. Now, it's not your fault if you have a bit of an adverse negative reaction to the words debits. It's because, again, you've been conditioned, you've been taught, through no fault of your own to react that way to it, because I'm assuming just about everyone watching this has a bank account which is nothing more than a demand deposit. That would also include a debit card. Of course, yes, there's the word in the name of the card we're talking about. Now, demand deposits, again, you put your money in a bank or any institution that will take deposits like that, regardless of what they label themselves, savings and loan. Those demand deposits are all liabilities to the bank. So what they're doing is they're giving you half of the whole transaction. That's the problem here, is they're not giving you the whole story, so that's not your fault. So what I'm going to do is go to the next slide here, which is going to be, we'll cover all the transactions again in this format, which you'll notice is the same as the other one, except I just did I changed the dominance of debits and credits and left and right. Now, just to go back a slide, I subliminally included in the supplement page 2, I indicated the abbreviations for debit and credit as DR and CR. You saw left and then in brackets you saw this weird DR and this CR sitting there. Well, those are the abbreviations for debits and credits. Now, I know I usually get a puzzled look from people when I teach this in person that where in the heck are you getting an R from the word debit? I can clearly see debit has no R in it anywhere. Is there an invisible R in there? No, there isn't. That's not the case. It's that the original terminology for this goes back to Latin, which of course is a wonderful language to use in a profession if you're trying to make sure that pretty much nobody knows what you're talking about except people within the profession. So that's why professions like, for example, the legal profession still relies heavily on Latin, because they know that most people are not going to understand it, so therefore you need their services basically to interpret what's going on. So that's where they get the DR from. So it's like debitaire or something. Might be a footnote in your book, may not. It might be something you can Google if you're interested. Not necessary though. It's up to you. All right. So going back to the other slide there. So again, I just took those dominants of those and said, let's just make the debits and credits aspect more dominant here. Let's put it at the forefront. Just clean that up real quick. And what I'm going to do here is I'm just going to say, let's pretend this isn't accounts payable. This is actually a very, very badly drawn D. Tried to make it DD for demand deposits. Again, still not gaining any discernible skills with this format. There we go, DD. All right, so we're going to go through an example of what the full accounting would be for a withdrawal and a deposit to a bank account, or a deposit to an account linked to a debit card, whatever the case may be. So let's say you're taking $1,000 out. Now this is what it would look like in the demand deposit. I'm just going to abbreviate this just 1K. There's your $1,000. So they say we're debiting your account, right? Okay, so again, that's the purpose of the debit account, so you can just pay something directly out of the account itself. And of course, every time you pay, it reduces the balance. What's the other half of that transaction now? That would be this. That money is no longer in the bank account, so guess what? Or say the bank's account, not just your account, but the bank's accounts. So their cash account for the bank was credited for that. So again, they both simultaneously debited the demand deposit for $1,000 and credited cash for the same amount. That's the full transaction. Because remember, you got to have one of each. It has to equal. So there's $1,000 worth of debits, $1,000 worth of credits. That's the reality there. Now let's say you deposit the same amount in that bank account linked to the debit card. So of course they're going to say, we'll just keep it the same amount. So you deposit $1,000 in there, so they say now we're crediting your account. Why? Because their liability went up. They owe that money to you. They have to pay it if you on demand. But also, what's the other half of that? Well, they're going to debit their own cash account. So there's a debit to cash and an offsetting credit to demand deposit. So once again, everything balances out. And again, what's the problem here? They're only giving you half the story. That's the real issue going on here. All right, let's do the remaining, or I should say all the transactions, not remaining. There's nothing remaining here. All the transactions from before in debits and credits. And from here on out, I'm pretty much just going to refer to everything, every transaction as debit this, credit that, no left and right. I might fall back on it occasionally, but mostly I like to just stick to this format. This is what I like to refer to as the immersion portion of the program. And in some ways, you're getting off a little bit light, actually, because if we wanted to be really mean about this, we could just start it from the forefront of the class, throw debits and credits in your lap at the beginning, and just make you deal with it. As is the case with some foreign language instructors. That I had no personal experience with that, but I had a friend in college that had personal experience with a Spanish instructor at the U of I, who talked. I think he said 3 or 4 words of English is all the instructor she had said in the first class. And I was like, oh, sorry to hear that, Fred. And he looked pretty dazed and confused and not too happy about the situation. So we try to ease you into it a lot, slower in accountancy than they do in maybe other disciplines. So anyways, let's go over those same 10 transactions. And again, I'm just going to say debits and credits from now on. So transaction 1 was still the same as before. It was the $1 million being procured by, in exchange for the 50,000 shares of stock for MST3K. So Mike Nelson gave that $1 million for the 50,000 shares. I'll get it straightened out here eventually. So again, that was a debit to cash and a credit to common stock. There you go. So again, that's how we would refer to that in the profession, not left and right, because again, we rely on debits and credits. So transaction number 2 was purchasing 10 trucks for $250,000 cash. So debit trucks and credit cash for that. And then transaction number 3 was purchasing supplies on account or on credit. Remember, those are interchangeable. So that means that you're going to debit supplies and you're going to credit the AP to indicate that you now owe that $3,500 to someone. Transaction 4 was the providing services on account for a customer, $50,000. So we want to debit accounts receivable for the 50, and then offsetting credit to fees earned because we have now earned that $50,000. So that's once that has occurred, timing, the dictates here is that you have to say that that is now revenue at that point. That's always going to be your key. Once it's earned, you now have a revenue. Transaction 5 is another revenue transaction because we provided services of an amount of $15,000. In this case, it was for cash. It was in the exchange you're paying up front. So debit cash, credit fees earned for the $15,000 there. Transaction number 6 was doing some routine maintenance to the truck. So that was going to be repairs expense debit. And of course, we were going to reduce cash by a like amount, $5,000. Number 7 was paying off that $3,500 that we owed to our creditor there. So again, you can say, now if I say pay creditor, that usually means just that language right there means, oh, it's already on account or on credit. It's redundant to say on account or on credit in that instance. But if I say paid and give a name of an organization and you don't have at your fingertips what the relationship of that organization is to yours, then you say pays so-and-so on account, then we understand, oh, that's an amount we already owe. In other words, whatever that account payable was, whatever its reason for being is has already happened. We're just paying it off. So at that point, it just necessitates a debit to the accounts payable and then a credit to cash. So there's nothing else that's involved there, just extinguishing the debt. Transaction 8 was receiving $50,000 on account. Now, if you hear that language, again, usually if you're receiving money on account, that means it's from a customer. There's no other context in which that would really be happening. So, but you can throw that in there. Again, if I see a specific name received $50,000 from this company on account, you need the on account so you understand what the relationship is, that you've already recorded the revenue. You're just saying, well, we're going to debit cash 50, and there's an offsetting amount that we're going to take out of accounts receivable because they no longer owe us that $50,000. But again, there's no need to record the revenue. Again, very common mistake for people when they see that payment, because there's this sort of, it's most of us are wired this way. We think cash equals something like revenue, and that, no, not at all. No, again, revenue, what's the timing? When it's earned. That $50,000 was already earned in the past. And just so you understand a little bit more here, when you're talking about collecting on a receivable, they usually don't happen in the same period. They can, right? But usually it's like this. You book the receivable in June, and then, of course, the offsetting credit to the fees earned, in this case, the revenue account, and then it's in July when you collect the 50, right? So the timing of the revenue is in 1 month, and then the timing of the collection is in another. So that's why it's all important, because everything you'll notice in this class as we build onto everything is all about timing when we recognize things. Number 9, almost done here, is payment of $25,000 of dividends to Mike Nelson. Again, so we're going to debit dividends and then credit cash for that $25,000. Just kind of painting over the 9, whatever. And then 10 is recognizing $2,500 worth of supplies being used in the business. So supplies expense should be debited in that case, and we'll have a credit to supplies to recognize that those supplies are no longer on hand. And as I emphasized before, our balances are the same as the original example. It was just the accounting equation. Except, again, one thing to remember is this retained earnings account's just kind of like hanging out. It really doesn't have a lot going on to it. But remember, what's going to eventually happen is we're going to do what? We're eventually going to move this $25,000 is going to get moved to the retained earnings account, so it'll be, in effect, a subtraction from it. That $65,000 will be eventually moved to retained earnings, credited to it, so it'll be an addition to it. And both of your expenses have the same impact on retained earnings as the dividends did, which is it will be a reduction. So that will actually happen when you do the closing process. It's just not happening here. Again, you're accumulating information so that you can do your financial statement. So that's why we got to keep those accounts like dividends, fees earned, repairs expense, supplies expense separate. And in the next video, you get the terminology for what do we call those types of accounts that I'm describing right here. Like there's a specific term for those, as is there a specific term for all the ones that aren't included in that group you're looking at there. So check out the next video, part 3 of this, and I'll see you there.